In this video, we're going to talk about why I'm buying QQQT SPYT, and I'm going to explain how they work, and we're going to talk about the yield max NAV erosion as to why that's happening. If you're interested in high yielding dividend paying stock and the ones I'm buying, stick around. I know you're going to like this one. Hey, welcome back everyone. Let's talk about two monthly dividend paying stocks that I'm trying to accumulate more and more and more. Every time I write a covered call or sell a cash secure put, I take those premium profits, and we're typically buying any number of monthly dividend paying stocks. Right now, two of them that I really love, QQQT and SPYT. Now, I'm going to explain why I like these, but what I want to talk to you about, years and years and years ago, when I used to buy dividend-paying closed-end funds, typically you can collect anywhere between 9 cents to as high as 22 cents for a covered call buy right ETF or closed-end fund. So what they would do is they would buy stocks and then write a covered call. They would do this time and time again, and they would pay anywhere from 12 cents to 22 cents based on the closed-end fund or ETF that you purchased. EOS, ETV, those were my go-to. And typically, I expected to make 9 cents to 16 cents. Now, I know there's a lot of different monthly dividend paying numbers there, but for the most part, back in the day, closed-end funds, if you made 9 to 10 to 11 cents per share, you were doing pretty good. Then the buy right covered call ETF showed up, and you can make 12 to 16 to 22 cents per share. And that was the holy grail of dividend ETFs and closed-end funds. That's what you could expect to make. And you would buy many of them to generate the monthly dividend income. Now, their NAV or net asset value would not erode because they held the stocks or ETFs they were trading, and that gave the fund the legs to stand in the stock market. And typically, if you look at a fund like EOS over the years, you'll see that it pays that dividend every single month. It also holds its value and moves higher. Now, EOS uses the buy right covered call, and that's how they generate their dividend. And that dividend is typically about 15 cents a month per share. So if you own 1,000 shares, you're going to make about $150 a month. And that's how the monthly dividend paying stocks would become the go-to for wealth managers creating income for their clients. Now we fast forward to current day, where you have all of these ETF companies that are using options. They're simulating an ownership of a stock, and they're writing covered calls, and they're using daily, weekly, monthly covered calls, and they are producing incredible monthly dividends for their investors. Now, here is the number one problem and criticism. Companies like YieldMax and Defiance and all of the others that are slowly showing up to this game, they use a synthetic trade where they create using call and put options to generate a synthetic ownership of the underlying. And what they do is they write near-term covered calls that could be daily or weekly, and they're generating huge amounts of money. I mean, we're talking $1, $2, $3, depending on what fund you're buying. I mean, YieldMax is famous for this because you could look at Tesla paying 81 cents, PayPal paying $1.60. You have Misty paying almost $2. It is an income investor dream to be getting that much money per share per month. But the problem is when you create a synthetic trade, you have no NAV as your base. So as they pay these huge dividends, they're giving it all back to the investor. So an $18 stock for which they are giving $2 in dividend, the very next trade after the X date, this bad boy is going to trade for $16. And they're going to do this time and time again to the point where this $21 stock, when at inception, pays so many dividends or return on capital it falls and falls and falls. And what happens? When it gets down to 10 bucks, 9 bucks, 8 bucks, the fund has to start considering a reverse split. And there's one reason why. You can't have this thing keep falling and falling and falling because the NASDAQ will delist you. NASDAQ has rules as to what your share price needs to be to stay listed. So these companies did a lot of work to get these funds out there. They're definitely not going to let them just fall and fall and fall and fall. So what can we do to invest in these high yield dividend paying stocks, yet invest in things that won't fall tremendously because their NAV is being eroded every month? Well, that's where I like QQQT and SPYT. And I'm going to show you why. First of all, these things will pay about 35 cents per share per month. And I love that number because if I'm a closed-end investor where I used to make 10 cents per share per month, 35 cents is like 3 times that income. And I like how they're using the NASDAQ. They're using an index. And in the case of SPYT, they're using the S&P 500. Both of these are going to pay about 31 to 35 cents per month per share. Now, I like that. Again, I like that because when the stock goes ex-dividend, it's only going to lose 31 cents per share. Like, we're not going to wake up and they're going to pay us a $3 dividend and this thing is trading for 16 bucks or less. So, I love the fat dividends YieldMax is paying. I mean, everybody loves it. But what I want is a consistent monthly dividend portfolio. And this is where we find what QQQT and SPYT do to derive their dividend. See, this is where a lot of people drop off. See, they don't do the legwork needed to understand how these companies derive the dividend. YieldMax, they have single stock funds where they use a single stock. They create a synthetic trade for which they write calls against it. And then the NAV erodes because they have no underlying supporting it. No underlying that props up the net asset value. If you don't know that, then you will absolutely be shocked when stocks like ULTY go from 21 bucks all the way down to $10. Yet this thing is paying $1 every single month. Okay? So you have to understand how the dividend paying stock or fund derives its dividend. In the case of EOS and ETV, they would buy the stocks and do a buy right covered call. And they own the underlying. So, for the most part, it holds its value. Now, you fast forward to the YieldMax funds, where they don't have any underlying assets, yet the cash. And they're paying you all that cash. So what it really turns out to be is a return on capital play. You're going to hear people say all the time, you're collecting all this big time cash, and it's going to go to zero, and everybody's going to bitch and moan. If you understand how they derive their dividend, you would not be shocked. And you would also embrace the reverse split because I have my own opinions on this. I believe they're going to reverse split these things forever. Remember what doesn't get reverse split? The cash. They are still using all of that cash to generate that fat dividend. And now they pay that fat dividend out to less shares. Right? Where let's say they had a pool of 1 million shares. They reverse split it to 500,000, but the cash is still there. The fat dividend is still there. So now they're paying more per share. Now, granted, you lost half your shares. That does not change the plan. And to be honest with you, unless they figure out that whole NAV thing with the YieldMax funds, we're going to be talking about NAV erosion for years. That's why I like YieldMax and YieldMag, because they own the funds inside of the funds. And they pay about 50 cents. I'm going to be investing more in YMAX and YMAG. Now, they've fallen off in the recent stock market. Why? Because the underlyings in the fund have fallen off. People are saying the sky's falling on YieldMax, YMAX, and YMAG. Of course, everything has fallen. I just don't understand how people think. They act like they haven't been in the stock market that long. Now, back to this. We got QQQT and SPYT. I love both of these because if you've read the prospectus, you see what they do. And this is what I really like about it. So they're going to go ahead and they're going to use ETFs that track the NASDAQ 100. Right off the bat, you could say the QQQ. They're going to invest in the QQQ, which is a basket of stocks because it's an index, so it holds its value. And then they're going to write what seems to be daily credit call spreads on the index. Now, a credit call spread is pretty simple. What they're going to do is buy the QQQ, and they're going to write a covered call, which seems to be daily in this case, and then they're going to buy a longer dated call option. So if they get involved here and it makes a move up to here above the strike, well, they make money both on the covered call and maybe the out of the money strike stock appreciation, plus that little call option they bought, they're going to make money on that too. So this is an option strategy I like, largely because one, they pay about 31 cents a month. Again, a $19 stock loses 31 cents every single month. That is nominal, right? They're using the NASDAQ, which is the QQQ. They're buying that asset. They're then writing covered calls, and they're using that long-dated call so they collect some upside. I love this strategy because, one, we're not getting that hella NAV erosion, and we're collecting 3 times the dividend that you might have collected had you been using a closed-end fund that only paid you 10 cents, right? Let's keep our hurdles low here. Keep our expectations low, but let's accumulate many of these shares. So let's take a look one last time at QQQT. Again, I love it. You can see it's trading for about $18. This thing has just started. Notice that its net assets is about $12,500,000. We can look at SPYT. It has been trading longer, so you can clearly see it's held its NAV because the S&P 500 has gone higher. The NASDAQ is going higher. We're getting this time of fluctuation, so we're going to be up and down. But for the most part, if you look at the chart, we're moving higher, and that's what you want here. And because these things are paying about 31 to 35 cents per share, you're getting about 3 times the dividend what a closed-end fund or an ETF that uses the buy-right strategy where they might pay 10 cents a share. So right now, I am really digging QQQT and SPYT. I own shares in both. I own about 1,800 shares in SPYT, and I own over 700 shares in QQQT. We're going to collect these using our covered call premiums and our cash secure put premium profit until we amass 3,000 shares of each. So that's why I like QQQT and SPYT. If you have any questions, feel free to email me. They pay once a month, and they typically pay in and around the 14th of each month. So what does that mean? You need to be in the night before the X date. So when you see the X date being posted, you need to be in the night before so you can lay claim to the dividend, because what happens on the X date? That ETF trades X dividend. And if you wanted to do the dividend wheel, you could sell it on the X date, use that capital, and commence to doing 2 to 3 weekly cash secure puts, generating nice premiums, and then you buy the stock with all the money you've made, plus the capital for which you sold. Hey, you may not quite understand that, but it works. I've been able to add over 300 shares to my SPYT trade by doing just that. Hey, look. Be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.